How long can you fund a whole life insurance policy that has a very low base premium? Perhaps a 10% minimum premium, and the other 90% of your money is going toward your PUA rider. The answer is as long as you'd like, provided the company and product that you're selecting allows for that. Today, we're going to look at an example that displays a whole life insurance policy with a 1090 split with the option to fund as long as 30 years, and it could even be longer than that. But you'll see the length of the funding period will be 30 years in today's example. So what we're going to look at is someone who plans to fund the policy with $100,000 per year. He's going to look at funding it for 10 years, but then he'll look at that exact same policy with no adjustments to the design, but funding it for 30 years. Now, the MEC limit has to do with that taxable limit on a life insurance policy. Why people are often attracted to cash value life insurance is because the cash value is a safe place to put money. I can access it anytime, a lot like a personal line of credit. And if I follow IRS rules, I can access it tax-free, which is nice. Now, how we can mess up that tax-free benefit, one example is if we trigger what is called a modified endowment contract, or MEC. How we prevent that is by not paying more money into our policy than whatever the MEC limit is. And the fun part is we can set the MEC limit wherever we'd like when we start a policy. So for someone who wants to fund $100K per year, we would set a MEC limit at a minimum of $100,000 per year. If someone said, I want to fund it for 30 years potentially, then we would probably set that MEC limit a little bit higher to prevent any chance of a long-term MEC occurring. Okay, now, sometimes we'll work with folks that are unsure of how long they want to be able to fund their policy. So what we'll do in a case like that is just set the MEC limit a little bit higher. We will not do this by increasing the base premium. What we'll do is just add some extra term insurance to the policy. It's a very low cost method to raise the death benefit. If you said, I don't care about the death benefit has a direct relationship to our MEC limit with the policy. And if we add that extra term and then say, I never used it, I bit off more than I can chew. Don't worry, you can always remove the term later. You can partially reduce it or remove it altogether. So with a whole life insurance policy, if I'm going to fund up to $100,000 per year, this 1090 split up here represents the 10 is 10% of our money going toward the minimum premium or the base premium. Base premium dollars buy me life insurance first. It's also the minimum amount that I'm billed for, so I am required to pay this, especially when starting a policy. And then third, they also generate the highest commission to the life insurance agent and agency, which are the outlets of that policy. You can buy a policy from a licensed agent or agency. So if I'm going to put $100,000 into a policy, premium dollars will satisfy life insurance first, cash value second, and also generate the highest commission. And they commit me to a higher dollar amount too. Whereas PUA dollars, if I put my other $90,000 here, this will prioritize cash value. It's flexible, meaning I am not required to pay that to the same extent I am with the base premium, and they generate the lowest agent and agency commission. On occasion, we do run into objections with minimum premium designs. We usually run into these objections from other agents that recommend going with a higher base premium. The reasons we often hear to support this argument is going with a low base premium policy can result in a MEC occurring down the road, which is very easy to prevent. You can just set that MEC limit higher, very, very easy fix. Another argument we hear is that a higher base premium will result in a higher dividend for a policyholder, which, if you look at an illustration with a higher base premium, it is true that the higher the base premium is, the higher the dividend is. Here is the item that is so critical to be aware of though. A higher dividend does not mean more cash value. The dividend column on a life insurance illustration and the annual dividend that you receive on your yearly statement does not include the guaranteed interest. So if you want your bottom line, I would just follow the cash value. And minimizing that premium, guess what? Gives you more cash value. So how long can I fund a policy? We're going to look at 10 and 30 years here. So let's take a look. What we'll begin with is the actual illustration. So we can see exactly what it looks like here. And then we'll look at it on Excel. So here, we've got 100K per year going in. And let's start actually by looking at the 10-year example. And then we'll look at 30. So what do you notice here? Well, on the left, we see our annual outlay, 100K per year for 10 years. All right, cool. Of those $100,000 payments, here's his base premium. That'll always be lined up with base policy insurance. With some companies, it's lined up with the product name itself. But that's our base premium. So a 10/90 split means 10% of our total payment is directed toward the base premium. Then we've got the other 90, it's more like 89 to be precise, but the other, call it 90%, is directed toward PUAs. There's one PUA rider. This other $2,000 is a combination of money going toward a term insurance rider and PUAs. Okay, cool. So looking at this guy, 100 goes in. There's your first year cash value, $92,000 and change. By the fourth year, you've paid in 400K. Your total cash value is just about $400,000. This is a 40-year-old male, regular preferred, so second best health class. So he funds this policy, or this example, for 10 years. After the 10th year, he pays nothing. After the 10th year, you'll see this column here, annual surrender. What this represents is the base premium, that's what that 10K is, that's still due, but he's not paying it. The policy is paying for itself through the dividends and interest that are being produced. I say dividends and interest because this dividend column does not include the guaranteed interest. How you can tell is look at the cash value growth over here. Let's just look at year 11 to 12 because you pay in nothing. This will be easy to track. Your cash value is 1.228. What's your dividend? 30 grand, 31,000? What's 30,000 plus 1.228? It would be 1.258. But what is your cash value the next year? 1.289. What's going on here? The guaranteed interest is not included in that column, which is beneficial to be aware of when I'm looking at illustrations and looking at the numbers. All right, back to the funding period. Can I fund longer than this without triggering a MEC? Yes. So for the MEC, firstly, let's look at this. Our MEC limit is overinflated in this example at $124,000 because we wanted to be able to fund it for a longer period of time. What we can also look at are details, where you can get MEC information here. Here we go. The policy is not a MEC based on the tabular values. The policy is not a MEC based on the supplemental values. I like the supplemental values because this displays the custom funding period, meaning this policy, this particular policy, premiums can be paid until I'm 85 years old. So 45 years because he's 40 years old. The tabular values assume that premiums are paid forever, whereas the supplemental values assume that premiums are paid for what I plugged in the illustration, 10 years in this example. Okay, let's look at the 30-year example. So same policy, 100K per year going in, premiums up here, exactly the same breakdown, same first year cash value, same break even, just about year 4, same year 10 value. I'm going to pull up a side-by-side in a moment. But the difference here is I fund for 30 years. Check that out. And my MEC limit is exactly the same because it's the exact same policy. Pretty cool. Let's go up to the MEC section and see what it says. Policy is not a MEC. Policy is not a MEC, which is fantastic. There are some additional tests that you can run here because this is just based on the current dividend rate. What you always want to look at to stress test a policy in terms of the modified endowment contract occurring later is what if dividend rates go down? Or what if I run it just with the guarantees? A lower dividend interest rate environment will put more stress on this in terms of a MEC occurring long term. Dividends go up, usually has the opposite effect, which is nice, meaning less MEC risk. Okay, let's take a look at a side-by-side here. So what we've got first is the 10-year fund. Next is the 30-year fund, but funded just for the first 10 years. Why we did this is because we can see they're the exact same policy side by side. The only difference is we're going to keep adding money. So the example to the left, you stop. The example to the right, you don't stop. In this example, he keeps funding $100K per year. Does he have to do that because that's what the illustration showed? He doesn't. He could pay just the base. He could pay a 10K base and 40K in PUAs, could be 30K in PUAs, could be anything. So he's got a lot of flexibility to continue to scale it from 10 to 100K per year. We just set it up where it's very, very flexible from the get-go, because this is with Mass Mutual. Mass Mutual as a company, wherever we set the base premium, will let us illustrate up to 10x that in PUAs. So we want to be aware of the insurance company limits. So that's where we came up with a 10% minimum premium. And then the other limit we want to be aware of is the MEC limit, because he might want to fund longer for 30 years. I went higher than we normally would with the MEC. It's about $125,000. That's a little excessive. For him, it doesn't really cost that much because we did it through term. But you could easily set that lower and still not have to worry about the MEC, because you got plenty of extra MEC space. And the thing is that a lot of times people don't understand about the MEC and panic when we don't have to panic is, if my MEC limit is 125 and I pay in 100, that means I had $25,000 of unused MEC space that's going to carry over to the next year. So now my MEC limit the next year is 125 plus the 25 up here, which equals 150. I'm just going to do it this way. And it'll continue to compound year over year. So year 3, it'll be 175, then 200. So that unused MEC space that'll compound over time is going to help me prevent a MEC down the road. What'll wipe out the unused MEC space is if I cut the term rider, that's classified as what's called a material change. That would impact it. So I want to be aware of that. But we only do that when someone hits a point in time where they say, hey, I'm done. I don't want to pay anything into this anymore. I say, no problem. Let's just look at the examples before we solidify that. Okay, so to wrap things up, can I fund a 1090 policy for 30 years? Yes, the answer is longer. We've looked at examples where people have gone up to 50 years. The longest I've illustrated before is about 60 years. That was for someone in their early to mid 30s, I believe. Took them to 90 years old. But with a 1090 split, what it gives you is a minimum premium. This gives you a lot more flexibility because that's all you're committed to. It's easier to stop early. Remember that example where we funded for 10 years? Remember that annual surrender column of that 10K per year? He wasn't paying it, the policy was paying for itself. If you have a higher base premium and you want to stop funding the policy altogether, the policy will often have to pay that premium for you through dividends and interest, or you can kill it sometimes with a reduced paid up option, but then you forfeit the right to continue to make payments. So I do like those low premiums because they let us stop early, which is nice. Also, a low minimum premium allows us to adjust the funding. And then here's the big thing, it maximizes the cash value. When you look at the guaranteed cash values, a minimum premium will give you more in guaranteed cash value every single time. The only time I wouldn't see that be the case is if I'm cheating when I'm looking at an illustration comparison. What that means is I'm looking at a 1090 and deliberately keeping the term rider attached for a long time and not doing that with a policy with a higher base premium. When you keep it apples to apples, you will have more money on a guaranteed basis. The non-guaranteed values, in most cases, you'll see more short-term and long-term with that 1090, and the actual results, I've always seen more with a 1090. And to wrap things up, corporations maximize cash value from day one, and they want the option to continue to fund their policies for a long time. In some cases, if they're taking out policies on executives that might be a bit younger. So I just say that to say they're maximizing the upfront cash value and funding it for a long time. Anyone can do the same thing that they do. It's just really knowing what to do and having the knowledge to be able to set a policy up that way, or working with an agent that has the knowledge. That's really it. So With all of that said, I hope you enjoyed this video. Please let me know in the comments below. You could also DM me if you'd like. LinkedIn is my personal favorite platform, or you could check out our website where we've got a bunch of free courses and PDF guides that give a ton of information on all things cash value life insurance and a lot more. As always, I hope this helps. Thanks so much for watching.